In this video lesson, we will discuss what to look for when entering and exiting trades. As a trader, it's important you develop some sort of checklist when deciding what and when to enter into a trade. It's simple. The more factors that meet your criteria, the higher the probability of that trade being profitable. Often traders settle or focus on just one particular factor that has caught their eye when trading, then get frustrated when that trade doesn't work. If all the factors are not analyzed, a signal can easily be misinterpreted, causing avoidable losses. We highly recommend you thoroughly consider the following potential factors when deciding if and when to enter into a trade. First, the most important thing to consider before entering into a trade is where you're going to get out. You need to have a set exit point should the trade sour, as well as the desired target should the trade prove fruitful. This will help you determine whether the trade meets the necessary 3-to-1 reward to risk ratio. For instance, entering a trade with a set target of 25 cents while having a 15-cent stop behind your entry point does not meet our 3-to-1 reward to risk ratio. While placing this trade may seem harmless, it's actually a bad idea, as over time trades like this one will eat away at your trading account. As a trader, you have to accept that you're going to be wrong often. Therefore, it is critical you do not force yourself to have to be perfect. By only placing trades that meet a minimum of 3-to-1 reward to risk, you can find success even if you're correct less than half the time, which takes a lot of pressure off you, the trader, having to be perfect. Also, by making sure you have a set exit before entering, you can cut losses early and avoid the temptation of having to hold on to losing positions. Remember, you could always get back into a trade later at a better price. The next important factor to consider before entering into a trade is what does the price action tell you on the time and sales, also known as the tape. Basically, look for patterns in stock appreciation or depreciation from the prints occurring on the tape. Just to be clear, a print is a term used by traders for transactions taking place on the tape. Therefore, when looking to enter into a position, you want to make sure the prints are favorable. If the prints constantly occur on the bid, then the stock price will go down. And if prints constantly occur on the offer, then the stock price will go up. The next important factor that should be considered is order flow, both on the level 2 and an NYSE limit book, if trading an NYSE stock. You should always look for support and resistance created by large limit orders parked on the level 2 and NYSE limit book, especially ones that coincide with chart patterns. Always use the level 2 and NYSE limit book to determine the liquidity and depth of the stock. Moving on to the next important factor, the stock chart. This seems simple enough, but often traders make costly mistakes when they enter trades against the trend. Look to buy stocks in an uptrend and short stocks in a downtrend. This will save you a lot of headaches as a trader. Another important factor that is often overlooked is the trading range. Look for stocks with an intraday trading range of at least 75 cents. Remember, the trading range is defined as the difference between the high and low for the day. The reason why the range is so important is because it is difficult to meet our minimum of 3-to-1 reward to risk ratio. The stock does not move a whole lot on the trading day. The next important factor that should be considered is the overall market and its effect on the stock you are currently looking at to enter. As traders, we typically use the S&P 500 as our market indicator, not the Dow Jones. The reason is simple. The Dow Jones is comprised of slow-moving worldly stocks, while the S&P 500 is made up of a variety of stocks, and therefore a quicker indicator of change in trend. Generally, you want to make a habit of entering into positions in the same direction as the market. The only exception to this is if the stock you're currently considering has extreme strength or weakness on the day regardless of the market trend. This is something we will discuss in much further detail in a later video lesson. Moving on to the next important factor, the sector the stock is in. Considering how the sector is performing is often more important than the overall market, especially if the stock is part of something very sector-driven, such as oils or gold. Another important factor to consider is the time of day. This is extremely important because depending on what time of day it is, should determine what you can expect on the trade. Most major moves take place from 9:30 a.m. to 11 a.m. and then again from 2:30 p.m. to 4 p.m. In the trading hours between those times, it is common to see stocks consolidate and chop around. Therefore, in the first and last hours of the trading day, you want to be aggressive and actively look for trades that can move a lot in a short period of time. While in the middle of the trading day, you want to find stocks that can trend slowly in one direction. And finally, you should consider the momentum of the stock. You should always take into account the speed and distance in which the stock is moving, as this will help you determine what a reasonable price target and stop loss should be. Also, it is key to determine what phase of the momentum cycle the stock is currently at. This is something we will be discussing in much further detail in a later video lesson. So to briefly recap, important things to consider before entering into a trade are exit points, prints on the tape, limit orders on the Level 2 and NYSE limit book, the stock chart, the trading range on the day, the S&P 500, the sector the stock is in, the time of day, and the momentum. Using these factors as a checklist will greatly improve your trading. If you make it a habit of only trading stocks that meet a majority of these factors, you will avoid some costly losses and increase your probability for success. Now that we've identified what to look for before entering a trade, let's discuss in further detail where to exit. Ultimately, stop placement is up to you as the trader. You can choose to use physical stops or mental stops. Physical stop orders are orders that you actually submit to the exchange, while mental stops are orders you submit manually once the stock price has breached your exit price. For this reason, mental stops require a great deal of discipline, as it is easy to be lured into adjusting your exit price further and further away, causing your losses to grow substantially. Therefore, if you struggle with discipline, always place stop orders immediately after entering into a position. Keep in mind though, regardless of whether you're using a physical or mental stop, it is imperative that you do not place your exit too close to the price action. Typically, the more volatile the stock, the wider you should consider placing your exit. However, if you are forced to move your exit extremely far away from your entry point, it most likely means that you should not be in the trade in the first place, as it probably does not meet a minimum of 3-to-1 reward to risk ratio. Remember, keep your losses small. If you're constantly giving positions 50 cents of space on your stops, then you must be making a minimum of $1.50 on your successful trades, which can be difficult to accomplish in slower moving markets. Therefore, we encourage reasonably tight stop losses in order to minimize losses. Try to find levels on the chart or in the order flow where you can place a comfortable stop behind. This will help you prevent exiting prematurely, as technical levels or large limit orders will provide protection from regular price action. Therefore, to wrap things up, when looking to enter into a position, use a trader checklist to consider how many critical factors are being met. And remember, when setting your exits, always utilize a minimum of a 3-to-1 reward to risk ratio.